happening, but hopefully giving you a kind of economic primer and a few lenses through which that world can be explored. So without further ado, let's dive in. And a world in which a lot is happening, of course, a world where certainty is scarce and where the same facts are even interpreted vastly differently by different people, depending on expertise, where they stand. And also, we need to extrapolate a lot from current trends, meaning that the future picture that analysts and experts are painting might be hugely different for 2026 and beyond. And I think this quote here absolutely underscores this. I'm not claiming to have any facts, but I'm hoping that I can show that there are fairly robust ways of interpreting what's out there and providing some kind of to-do list for 2026 and beyond. Let's dive in and welcome to Schrödinger's ad economy, an ad economy that is odd, that's hot and cold at the same time, alive and dead at the same time, just exactly like Schrödinger's cat, which can exist or not exist in various stages. And many of you will have experienced that through 2025, and I wanted to give a little bit of a primer on why that's the case and which economic forces have so far shaped digital advertising, and also how we should interpret, maybe not over-interpret them as we're entering into 2026. It has been a tough year for economists, and we can see that there's been a lot of uncertainty about predicting just how the macroeconomic landscape is going to evolve. We could see economic forecast discrepancy on record high in 2025 if we look at the level of agreement or disagreement between the kind of top 10 Eurozone forecasters who are looking at how GDP in the Eurozone is evolving. There are two parts of this chart. First, look at the gray line, which are in a sense confidence bands of the forecasts, right? Saying the dotted line is kind of the average, how economists were forecasting, and then we can see in the gray lines the kind of discrepancy of forecasts over time. And if you look at the x-axis, you can see the year is progressing, and as the year progresses, typically it's easier to determine how the year will turn out. In November, an economist doesn't need to use magic to understand how the full year GDP might look like. However, this quite obvious convergence to consensus over time has been fundamentally disrupted in 2025. And we can see this in the green line, where as the year progressed, we haven't seen the level of agreement increasing between economists, but it has been actually remaining on a high level and even increasing. Obviously, now as the year progresses, that line might go down, but it shows that somehow the economy is hard to predict, and maybe we don't even have the full tools available to really understand what's going on. And we can see this when we look at the market landscape as well, where different trends seem to interact together. And this world is, of course, hard for everybody, for businesses, for consumers, and also for policy makers. We can see, to look at this kind of Schrödinger's economy a little bit more, a dual rally kind of going on, which is odd because the rally kind of reflects two very different things. We see both stock prices going up and also safe bets like gold price has been going up, which showing the odd thing that investors have both an appetite for risk and they also want to protect against risk at the very same time. Perfect example of the Schrödinger's economy. We can also see it in a different metric when we look at the volatility index and the policy uncertainty index. You've seen me speak about the policy uncertainty index numerous times. I'll also quote it today again. But what you can see here is something odd. Usually, we can see that volatility correlates with uncertainty. Now, what we found in the markets is very low volatility, which is the blue line here, despite a surging economic policy uncertainty. Why is that? Isn't that fundamentally at odds? I think it's something when you reach extremes, you kind of start to see a breakdown of correlations. So we see this decoupling here because, in my view, the uncertainty is so high that investors just struggle to price it in and just give up on it. Uncertainty talking about it, remains, though, high in Europe. When we look at the Economic Policy Uncertainty Index, which measures the level of agreement or disagreement about the future trajectory of the economy. And we can see, of course, this is a new version where we looked at several European countries, not the global one, which is skewed by kind of Trump tariff fears. But we can see that overall, despite heightened level of uncertainty of where things are going to go, we have seen a downward trend at the tail end of this year, which is good news that either there's less uncertainty or experts are not doubling down on it. The stark difference here, of course, is the Eurozone's largest economy, Germany, where levels, although they're declining, remain far higher than the European average. World economic growth, we need to speak about it. Latest IMF forecast came out in 2025. It remains modest. And EU countries and the Eurozone are going to underperform global growth. Here we just have a sample of advanced economies. You can see world GDP growth is going much higher. So we continue to be in a muted environment. But good to see here that the experts are in particular seeing an increase in Germany after a couple of quarters or even years now of stagnant or even declining growth. But we're going to come to in a second whether this actually matters to us or whether it doesn't matter. Revisions, unfortunately, have been fairly modest, luckily in both directions, but it means that there is not really anything new that's remarkable between the July forecast of the IMF and the new October forecast. Very modest revision, and some of the kind of smallest and most cautious revisions we've seen in recent years. So we cannot say that the overall economic outlook, despite decreasing our levels of uncertainty, has gotten fundamentally better. We also have an economy that's odd, despite growth being there, and we need to see where it comes from. And I think the US is a perfect example here, where if we look at this chart, there are two sides. Let's direct our attention to the left at first, where we can see a measure of real business fixed investments. How much are our businesses investing? It's a slightly crude category, information processing equipment and software, which basically in today's world translates into mostly AI. We can see a rapid surge in the first half of 2025. Now, it would take the US GDP figure and real GDP and exclude all that investment that has gone into AI type services. We can see, well, growth in H1 2025 has to be looked at with a microscope. And if we do the math, we can see that AI investment, what's on the left here, makes up around 4% of GDP, but actually contributes 92% of GDP growth. This is what you could call a K-shaped divergence or a K-shaped economy, in an example of Schrödinger's economy, where the real growth that businesses or consumers are seeing might be at odds with what is available on the macroeconomic picture due to the very concentrated investments and benefits currently derived from AI. But even if we had robust economic data, can we actually trust it? And one thing is, these GDP forecasts, whether they are strong or not so strong, have a fundamental problem, as do other economic indicators. We can see this here both on the left and the right. Left is a US perspective where business and consumer response rate to economic surveys has been actually declining over the last decade. This has now reached a level where it's so problematic that the confidence in the forecasts is eroding. We can also see on the right side, UK an example here, that data quality is in decline. And in the US, it's a slightly poetic statement for a statement published by the Federal Reserve Bank: good data is hard to find. So the economists are even getting philosophical and amusing about what can they do to increase the accuracy of economic data, as increasingly predictions on the world economy rest on ever more fragile grounds. Something else to consider is that rational market, if we can ever consider markets rational, but markets that believe to be rational, evidence-driven and empirical, they struggle to cope with instability in predictions. The investment fund PIMCO, I think, put it very succinctly. where they said, in a sense, Trump is a feature, not a cause here, talked about the traditional world order, post-World War II order, where economics used to shape politics, has been turned on its head. Now it's politics shaping economics. This is something that many believe is going to continue for a very long time, but traditional corporate risk mitigations and economic prediction methods are not geared towards that, as that practice evolved in an era when economics was shaping politics and not the other way around. We can see this everywhere, and this is a chart from the Federal Reserve. You can see that some economists struggle with producing high-resolution charts, but it's quite interesting for our purposes here. What you can see here is voting behavior, interventions in the UN grouped by motive and geopolitical bloc. So aligned blocks. So first of all, distortive interventions. They're kind of government actions that are geared towards altering the flow of trade. Aligned blocks are kind of country pairs that are aligned. Let's say Germany and France, or broadly the European economies, for instance. Non-aligned are neither strongly or closely aligned, and those who are distant are country pairs that are very, very far apart geopolitically, China, the US, etc. And you can see that there's more and more disagreement happening, or more and more interventions on the non-aligned and on distant blocks, meaning in a sense, this creates a damper on globalization, and we're seeing more and more business and focus moving inside blocks and not outside blocks, which of course has implications for global trade. But lastly, does all of this even matter for advertising? This is the toolbox we have available, but does it matter? Look again at the world GDP forecast, slightly kind of downward growth trend from 2024 to 2026. But ad forecasters were struggling to make sense of this. In June, Magna was revising downwards global ad spending forecasts in line with the economy. And you saw yesterday or day before yesterday released the new WPP forecast, an upgrade of 1.1 percentage points on the previous forecasts for 2025. So you can see quite different trends and perceptions coming in here. And one thing that we're seeing overall, that there is a decoupling from the underlying economic foundations, from advertising and the underlying economic foundations. And you can see this clearly here. Let's look at one of our Eurozone markets, Germany, the largest market in the Eurozone, where we used to have a historical correlation between GDP and ad spend. You can clearly see it here just descriptively on the chart, where advertising used to be amplified by GDP in both directions. Post-COVID, we're seeing a collapse of that correlation, and you can see it here from 2022 onwards, where despite fairly muted economy, we see actually fairly high, even double-digit advertising growth. And we expect that this is likely to continue. If we zoom in a little bit more and actually look at household consumption, which historically has been an even better single variable predictor of advertising expenditure. Makes sense. It's a demand index, right? How much are consumers willing to spend? And advertising was seen as a reaction to what's available in consumers' wallets to actually distribute that. You can see it even more starkly. Changes in household consumption year over year in the last few quarters was barely noticeable in the European Union, fairly flattish at around 4.1%. But what you can see in ad spend is it's wildly different. And we're seeing this progressive decoupling, the ups and downs, but in particular, this decoupling here. What many are saying, and which increasingly, I think, comes to the foreground of more and more experts and analysts, is that ad spend is often decoupled from the overall economy and more an expression of how profitable is a company and what they can spend, not the overall economy. You can see that here clearly when we look at the US, where we look at the corporate profitability over time with a base year. And then we can see recession recovery, post-global financial crisis rebound. We've got some kind of mid-decade stabilization, pandemic impact. After that historic peak, inflationary pricing power was there, and that was actually complemented with lots of brand advertising. And now we have businesses with a fairly highly sustained margin. And this is something that is a key driver for advertising, company profitability, not underlying GDP or very, very broad macro factors. Unfortunately, when we look at the EU 27, that picture, that rosy picture of corporate profitability driving ad spend isn't so present. In fact, we can see while American capitalism became maybe twice as efficient in terms of profit as the Europeans have been pretty much range bound for about 2 decades. We can see again here the key, in a sense, impacts, but it hasn't really moved the needle very much. I must say that I put this as an index because the underlying data between the US and Europe isn't comparable. I put it here in the footnote here, but the US and Europe use different methods to calculate this, so we need to index this in order to ensure we have a like-for-like comparison. What does it mean for us? It means, first of all, we need to worry less about overall GDP. Corporate profitability is a key driver. But downstream, it also means when it comes to advertising demand from European HQ businesses or even European divisions, the picture might not be as strong as on a global basis, or as some US analysts who are primarily looking at US companies are suggesting. Might also mean that more spend is coming from large corporates. If we look at the large advertiser component who have global budgets, who are coming from the US and not EU domiciled, EU HQ companies. Another thing that is kind of disrupting this GDP correlation is cross-border spend. We all know how important the rise of China has been. And it is becoming clear when we look, for instance, at the Meta earnings data. This is directly from Meta earnings reports. We have two ways of looking at it. And Meta provides two lenses on the world. One is advertising revenue based on the billing address of the customer, and also then advertising revenue based on where the eyeballs to which the ad was delivered are located. We can see a clear picture here that we see massive increases between 2017 and the first 9 months at 2025 in terms of percentage points, growth in the APAC billing addresses, which is predominantly China. So Chinese advertisers moving as the domestic market weakens, moving to the US and moving to Europe to find customers there. And this is actually supported if we look at good imports data from Europe. We luckily, thank you for regulation once, have pretty good data here from so-called H7 declarations. So that's a simplified customs declaration that was introduced a couple of years ago for goods valued under 150 euros. And that allows us to really track, these are kind of parcels like T-machine parcels, etc., track where those imports of these low-value items are actually coming from. It's predominantly e-commerce, of course. And we can see that 91% of these low-value item imports are now coming from China. Since 2022, with a compound annual growth rate here of 110% versus a decline in the import of low-value items from other countries. Again, showing how important cross-border spend, in particular, the power of Chinese advertisers advertising here in Europe has become to prop up the ad market beyond what you can see in macroeconomic data. But we have some positive news as well in Europe, because domestic European business adoption is pretty low, right? Digital advertising is 67% of all paid media budgets right now, but only shy of 33%, shy of 1/3 of all EU businesses that employ or have self-employed 10 people or more are actually advertising online. It varies hugely by country. You can see, for instance, Malta and Finland, very, very strong ahead. You can also see outside of the EU, the UK, a very digitized market, as we know, has over 50% of businesses advertising online. But just look at how much, in a sense, headroom of companies who don't advertise online there is across the board, even in some larger geographies like Poland, Spain, and France in particular. Meaning that although current budgets from large advertisers might not grow as fast, in particular the ones which are EU headquartered, there's in a sense net new demand coming in the market. In particular, it is smaller businesses though. as we can see here. Large enterprises are at least half of them already advertising online, but there's particular headroom in smaller enterprises. This all excludes, of course, the micro enterprise. We've got 33 million in there in Europe. They are predominantly gearing, if they're advertising, very small budgets going to self-serve platforms. But here, I think, is a huge opportunity for the European market. Indeed, if we do some forecasts, we expect more EU businesses to advertise and use online as their primary destination. So here we looked at the 2024 data, and then we did forecasts based on the historical growth rates that we've seen. Luckily, we have the DSA transparency data from the large platforms, so we can see via data scraping, etc., how the volume of advertisers is increasing. Also, we looked at the digitization index of European companies, and also, because it's not all net new, what is the cycle of bankruptcies and new businesses being started. So this is an uptick here. And the digital native businesses in particular are flocking to this, and smaller businesses, because, of course, online advertising has become much easier to access. This could, we calculate, lead to around 14 billion of new spend coming in the European market between 2025 and 26, so over a 2-year period. Here we can see the number of businesses advertising online. We extrapolated how many more net additions there might be every year. And if we look at average volume of spend per employee or per 100,000 euros, we can estimate in further it's around 14 billion that could come into the market. Beyond the advertiser expansion, we're also seeing an expansion of goods. An expansion of goods means more goods need to be advertised. This does not necessarily need to larger budgets if it's coming from the same companies, but we can also see a diversification of companies that produce goods that need to be sold. Also, it affects, of course, for existing goods, the advertising strategy as these goods, as we have more goods, there's less inventory on, let's say, storytelling type media, and branding and performance are coming closer together. So if we look at the number of different SKUs in supermarkets, massive explosion, the number of manufacturers available in supermarkets has seen an increase. And also when we just look at the diversity of products purchased on Amazon by customer, i.e. what's in the basket, it's still pandemic data, so it might have gone down slightly, but we've seen a huge uptick here. And this is also going to fire advertising demand. Key question, though, is inventory is not necessarily increasing, so this will have implications for pricing and CPM, and also how to calculate customer lifetime value and the relationship to advertising. So it's not all smooth sailing, but of course creates a huge opportunity for traditional media owners to expand the digital offerings, as that demand will need to go somewhere, and pricing considerations might also trigger decisions, conversations about channel shift. With all of this, our latest forecast shows digital ad resilience despite kind of muted GDP growth, and we see a slightly upticking economy, yes. So 2024, our ADX study, excluding Turkey here, as it's a high inflation country, I removed it. With Turkey, we would have been 16%. Outside Turkey, a 12.5% growth. We expect 2025 digital advertising 8.4. Our previous forecast in May was still 6.5, so we have upgraded the forecast considerably, and we're going to see a re-acceleration coming in 2026. Re-acceleration, you might think, why is that the case? Many will point to the Olympics, and this indeed is a huge issue in the US. When we look at the latest Madison and Wall forecast for the US, released a couple of days ago, they assume that we have a strongly front-loaded ad market, with Q2 and Q1 and Q2 performing strongly, and then kind of a slowdown here. I don't see the same skew in Europe, as we are less exposed to sports events. There's less cyclicality in the market and between the quarters. So I'm going to see a far more consistent growth pattern across the quarters. What does all of this mean? And when we look at advertiser priorities, how are advertisers operating in this new Schrödinger's economy? They're operating in a way that is distinct, and how they're operating determines media owners' product and service development agenda. It's right in the title. We see a strong move towards financialization, i.e. that finance and media are coming far closer together. Mercedes-Benz is just one example, but increasingly we can see in large advertisers that wider digital transformation initiatives are actually restructuring how advertising, how marketing is being thought of. This can be, as I mentioned on previous webinars, a driver for digital advertising as it can become more of an API between the company and the consumer. But of course, it also means that choices of channel and measurement is going to change. And when we look at how companies are speaking about digital, are speaking about marketing in their earnings calls, we can see something remarkable. First, they speak a lot about marketing. Even non-marketing people, CEO and CFO, are mostly the ones manning or womaning the microphone here. And we looked at this in a percentage of relevant utterances, i.e., what sentences or semantic units, once we've structured the earnings call in that way, are dedicated to marketing-related statements. Those sectors who invest proportionately to revenue the most in marketing, evidently, speak about it most. Consumer staples, comm services, consumer discretionary, etc. But look, it's nearly 20%. So marketing plays a huge role in actually convincing investors that the company is on the right track. What most do, though, is they link adjustments to marketing spend to overall company performance, net sales, percentage of revenue, etc. And more specialist focuses like linking it to gross merchandise value or gross bookings, Booking.com and others would be doing, is not very widely deployed. This, of course, works very well when the company is performing fine, and even we saw in recent years an outperformance, a stronger growth in marketing than growth in revenue, as we were in this period of brand building, justifying post-pandemic price increases, etc. But this mechanism cannot continue forever. So if marketing expenditure is linked to basic financial metrics, overall revenue growth, what happens when revenue isn't growing again? I found this chart here very instructive, which is, again, an index where we looked at share price index and revenue index for select CPGs. And you don't need to be a statistician to see that something is odd here. We saw, of course, massive growth in share price, overall market, cost savings, etc. But the underlying revenue growth was fairly anemic, 1.1% year on year on average here. At the same time, if we look at what these companies have been doing, look into their accounts and also their statements, that marketing investments are at the high marketing investments to earnings are at the highest ratio in the last decade. So this wouldn't apply to D2C brands, but for some large consumer brands, this of course is concerning as they're spending so much on marketing and it's not moving the revenue needle. Does it require a rethinking of the relationship between marketing and business growth? Do we need new channels, new platforms, new ways of working, etc.? Luckily, most marketers, they aimed for more spend in H2, and this is also why we upgraded our forecast. We looked at this initially at the beginning of the year. Kraft Heinz, nearly at the highest level in a decade. Others are saying we're going to continue to power on, and we have strong brand launches like Beiersdorf in the second half of the year. This is propelling things, and again, an example that this is being done regardless of how the GDP situation looks like. But if we look at some of the key marketer comments for 2025, and this is really just a very short, very small sample, we can see new priority areas emerging. Look at Unilever, for instance, concern about digital fragmentation and measuring it. Also, by the way, custom business outcomes, brand superiority scores. Coty, a whole array of different things, focusing on ROI, both short and long term, importantly. Providing more evidence on what AI is actually delivering, where is it happening, from planning, buying to creative, and also doubling down on social. We can see Beiersdorf focusing clearly on ROI and digital media. Estée Lauder, again, providing examples now, not just name dropping, of how deeply embedded AI type processes are already in the business and how it ties back to financial outcomes. Keyword, CFO needs to be happy. And also Henkel assuring investors that they're not cutting, despite high levels, a marketing expenditure as being seen so important for brand growth and share of voice. In those themes, if we abstract a little bit, we can see for the 9-month 2025 key development areas for marketers. Of course, here we look at in which terms have actually increased in the 9-month of 2025 the most versus the volume of mentions that we saw in the same period in 2024. Clearly AI, but interestingly also creative. Often, as we saw in the Coty example, not detached from AI, but combined with it. Outcomes, we're in the outcomes era, it's clear, but again, an indication of the financialization of marketing. Data and targeting, even for broad reach consumer brand, the very kind of Byron Sharpish advertisers, incredibly important to pay on to this financialization. But we see more mentions, and mentions don't necessarily translate into investment, but it shows there's some kind of mind shift, emphasis on brand investment versus pure performance. So more time is being spent talking about brand and of marketing growth brands than a pure efficiency and performance play. What happens on the advertiser side, of course, creates an agenda for the sales side. And here I want to rather selectively look at some of the trends we're seeing and how I think increasingly we need to get rid of the notion of the channel to rather look at business growth ecosystems. And I have some points in here, but what really triggered this was the recent Amazon Unboxed event in Nashville, where we looked at the integration of all the channels into one with a creative suite attached to the front, etc. Where it's less about through which channels that advertising go versus what ecosystem can I use, and the entire array of instruments available within that ecosystem, often decided by that ecosystem to drive my business objectives. Traditional media owners, or TMOs, the acronym, have of course been affected by broader economic shifts and also by shifts in audience behavior. We can clearly see this across the board. We see that in Europe now as well, something that was predominantly happening in the US. But despite potentially bad news here, and TV being most affected, I think we should also be proud and resilient in Europe, as looking across the Atlantic often paints a picture that is not entirely applicable to Europe. So despite the erosion that we're seeing, if you look at the long-term erosion of so-called content media, so all media channels that predominantly run ads against editorial content, we can see that, as an example, Germany here, standing in for Europe, has been far more resilient than the US, and we do have strong and resilient media brands which are still competitive and haven't faced the structural erosion as severe as in the US, meaning now is a good time to actually accelerate structural transformation. Yet, with all of this, of course, if we look at what happened in 2025, and we believe that it's going to set to continue in 2026, ad growth, where is net new money coming from, is highly unevenly distributed. Digital pure play players take the lion's share. The top 3 company in that, again, the lion's share, and the others are growing not so much. So, well, less than 10% of the overall incremental growth to be seen comes from non-digital pure play companies. Reminder, some of you know this chart, but it's important to contextualize what happens next. In this world of outcomes, and again, outcomes are not the only thing, but they're so deciding right now. Outcome machines are the next frontier, i.e. products that bundle all of these things together: creative, audience, orchestration, optimization, etc. That creates impact, and those who control decisioning, in a sense, control budget and future uncertainty. In this world, if we dive a little bit deeper, we can see a two-speed adoption, in particular of AR self-serve tools. There was a fascinating interview recently with Simon Whitcomb from Meta with Eric Seufert, who spoke about that it's particular small and medium-sized companies which are moving quickly on this. Makes sense, of course, as they don't have as built-out marketing organizations, but also interesting to say that a lot of the larger projects seem to be stuck at the experimentation and trial end and not using things in production yet. In Europe, of course, this is just a snapshot, not exhaustive. We could see that consolidation has gathered pace across 3 domains. In the free-to-air space, we saw consolidation. We also saw consolidation across traditional media owners, i.e. particularly in the television and digital television and out-of-home space, and also partnerships with streamers, in particular, for instance, look at YouTube, for instance, or Netflix, etc., where it's suddenly not about antagonists anymore, but about broader partnership. But the question, of course, is more of the same or reaching out to other parties. Is that sufficient? Well, we're seeing a heightened innovation pace in Europe and beyond, where sell-side players are building for both the outcome trend and for the small and medium-sized business trend. You see some examples here of different media owners, different products, and if you drill down, some are more explicitly small and medium-sized business, some not, but it's all about scale, single points of access, reducing barriers to entry, and reaching out to new, in particular, smaller advertisers. Footnote here, small advertisers are not necessarily growing faster than large advertisers, but given that many are not in this ecosystem and more businesses are moving online, this is certainly a crucial way to attract additional demand. Retail media has been a key focus of us at IAB Europe for the past years. If you look at our latest forecast issued at Demexco, which still stands, we've revised our outlook. We've revised it slightly down. Some are lamenting the end of the gold rush. I wouldn't go as far, but I would say the easy money is gone. And now it's about trying to professionalize offerings, provide better reporting, prediction capabilities to become a true media owner with full-fledged ad ops, measurement, etc., where many are still lagging behind, and that is putting a drag on spend. Good news for everybody in Europe, for Europe Inc. in a way, is that the move of retail media to offsite, again, advertisers wanting to use retailers as an ecosystem and not a channel to activate the data across different channels, is, from a very small basis, we must say, creating growth for the entire ecosystem. It's unclear yet how much of that will actually be unlocked, given data interoperability issues, general slowness of partnerships, etc. But it is a fundamental opportunity in Europe that we shouldn't overlook. Crucially, programmatic will play a role here as well. Whereas programmatic spend on the open web is kind of stagnating, we see, of course, on display, of course, in CTV, etc., we see continued growth. But if we look at these new ecosystems being built, we see a fairly low penetration of programmatic in retail medias, online and in store. Retailers need to acquire new demand, not reliant on their sales team or trade deals. So programmatic is going to be crucial for that. And also to really unlock in-store, which some are saying is going to be the next large media channel or the next television, if you will. It requires far more interoperability and the ability to buy without friction at scale. Now, retail media has been growing phenomenally, but of course, many thought they could be the new micro Metas and micro Alphabets due to their first-party data. We see too many networks in the space, and consolidation is inevitable. If we look here at an example of Europe, how e-commerce is being distributed in terms of revenue and kind of bucket that by company, probably the top 10 are going to be fine. In the rank 11 to 100, you've got to be a leader in your vertical or an aggregator, and in the rest, we're likely going to see more of a Google AdWords of retail media consolidation inevitable. Marketers see growth elsewhere, in particular also in the content space, although we initially talked about harder times for content media. In particular, we look at the creator economy. Here we look at the entire size of the creator media, not advertising economy, versus the corporate media economy, which includes everything: production, subscription, distribution, etc. And creator economy would include Mr. Beast's chocolate bars and potentially also his new amusement park in Riyadh, so not just advertising. But I think growth rates are speaking for themselves. When we look at recent surveys, here's a McKinsey survey on European CMO preferences. While creators aren't mentioned, when we look at the focus of key investment areas, percentage change here on the right, we can see an emphasis on creativity and uniqueness and trendiness and cultural relevance. And both of these are creator USPs. So as CMOs are building towards that, media owners who can offer something in those areas are going to thrive. We can see the creator landscape diversifying rapidly when we look at the number of views required to kind of hit the top 10 brand sponsors on YouTube, H1 2024 to 2025. We actually see there are fewer views required. right? Also, we see, interestingly, a set of advertisers which doesn't mirror what you traditionally find on television. So digital endemic brands are still reigning supreme here, both implications for television to attract those digital endemics and also for larger brands, which are they're doing like Unilever, for instance, now pushing harder into the creator space. And we can see this if we zoom out a little bit. I think one of the key trends globally and in Europe is going to be in that space, the addition of the mega creator world with kind of smaller or micro creators, again, evidenced by the sponsored videos by viewership ranges here. Interestingly, and this creates new development opportunities. To tap into this, brands are realizing we can't just start buying creators and that's it. It requires an infrastructure, an engine. And Unilever was quite clear about this after headlines came out about spending half their budget with creators, that actually under the hood, it requires hard work. It requires a lot of transformation work. Outcomes need to be built in, etc. So this is clearly something that not everybody can do, but also something that requires new services and specialists to actually help with that. So new business opportunities. We all know that, I call it the construct formerly known as the open web, whether it was an intellectual or marketing construct, we don't know, but of course it had a certain spirit. And this is being fundamentally reorganized. So again, as I showed in previous presentations, but we're seeing more pressure on this, margin compression, DSPs and SSPs wanting the same thing. The good news in that is that potentially more of working media goes to media owners, creating some additional growth. But we're seeing within the ad tech space that scale and strategic differentiation are absolutely vital. And if you are a mid-tier independent, there needs to be laser focus on what makes a USP, data, commerce integration, CTV, etc. The last thing we're seeing is that more and more of the large players talking about business growth ecosystems are internalizing ad tech, making the kind of rest of it a tougher battleground. You can see this from retail media, Kroger example in the US. Also, when you look at the recent Amazon partnerships beyond the offering that they have themselves, it's again more about building these business growth ecosystems with a single point of access. And it's crucial for media owners to figure out where do I play here with which partners and can I build something like this myself. A word of caution here, we spoke a lot about outcomes and some might raise eyebrows that, that outcomes are dead end. I don't think it's a dead end to look at business growth if we don't define outcomes as performance. But of course, there's something kind of a second order effect taking place here that marketers are moving towards this kind of infinite induction loop without actually gaining new insight into how marketing actually works. Because there's a fundamental difference between being data-driven versus evidence-led. Data-driven also means driven by data and not driving data. And evidence-led often is having abstracted general knowledge about how marketing works. One of my favorite books, this one here talks about the invention of modern statistics and how it reduced chance and enabled new ways of knowledge. Unfortunately, by focusing purely on outcomes, particularly those defined by third parties, many marketers are leaving this potential on the table. As the demand for a constant data exhaust means you need perpetual proof that something works and you're not abstracting knowledge. So there's a bias towards channels that can deliver this, and media owners unfortunately need to build it. But it also means that if you don't have it, it is an underinvestment, whether right or wrong, on channels where even you have, like in television, long, rigorous, longitudinal research, that stuff works. Because marketers in the outcomes and financialization world are not only data-driven, but predominantly driven by data. And this is something that is probably hard to change and easier to capture. Lastly, in the last few minutes, I'll look at briefly at AI and service model reinvention happening in this world. Economists are, as usual, bad at predictions and can't agree. This is a survey of chief economists from the World Economic Forums. What impact AI overall in the economy is going to have? Is it going to grow GDP, yes or no? Is it going to grow employment, yes or no? If you put it, it's kind of 50-50. But we know that in our world, AI is transforming marketing rapidly. Amidst all this frenzy, of course, large discussions about the kind of circular AI economy. If someone is a customer, an investor, and a third company that is kind of peripherally involved, has a revenue share, it means, is it a self-funding system? You might have seen many of those charts pop on LinkedIn, in the trade press, in The Economist, etc. And the lay versions of that chart would exactly be this. But are we here? Well, every bubble is different. In the end, it's an empirical question. And here's just an example of, I think, one way on how we could look at this in a more robust way. What's the economic strain? What's the industry strain? Is there revenue momentum, etc.? It might be, in a sense, a full indicator, but I think it's too early to say that this is a bubble and it's not going to affect advertising in the long term, which, as we can see, it clearly does. There's, of course, a few elephants in the room, in particular, if you look at AI search towards answer engines. If we split out data from early adopters and all searchers, early adopters, those that started to use ChatGPT within the first 3 months of its inception, and the general population, hugely different trends, right? Those early adopters have fundamentally changed their search behavior. Of course, AdTech is saying, well, we all know it's affecting publisher traffic and revenue, but AdTech is quick to say this doesn't affect our business model. This is something of huge potential. It's still unclear. Of course, we know now OpenAI, after many back and forth, is eyeing ads, as probably Anthropic as well. The advent of an IPO always means looking at an advertising business model. See Instacart as well. So unclear how third parties are going to thrive in this world. Publisher responses, we've seen many currently. Here's just an overview of what's going on. It's a very liquid landscape currently. We're now seeing the emergence of content marketplaces more as well. A huge discussion in that space is agentic commerce, which seems to dominate the headlines. How agentic is it really? We see lots of headlines like these here. At the same time, though, we can see some counter evidence. For instance, Amazon suing Perplexity and blocking it over shopping tool, as it, of course, wants to maintain control over its shoppers over product discovery, price discovery, etc., and not have an intermediary in here. So, is it a fancy distraction? Probably in the sense of a zero-click out, I give the AI my credit card, yes, because there are real structural and incentive contradictions going on here, exemplified by the Amazon Perplexity spat right there. If a large player blocks access via the API, suddenly the market shrinks a lot. Also, consumers like shopping. This is not a tech bro, let's optimize shopping out of the way question. As we all know, shopping can be a wonderful distraction. Also, existing solutions are already fundamentally simple. One-click checkout already exists, in particular for items of convenience that you can reorder and reorder. So we need some realism and not get distracted by agentic commerce, and rather look at how can we rewire our industry in other ways. Of course, AdTech has all the different phases expressed here in M&A trends, build-up phases, first-party data, video, in the advent of the sandbox, privacy-enhancing technologies, and then consolidation. And now, of course, we're in the new AI build-up phase with new features, be it NVIDIA PubMatic collaboration or new AI-native business coming, new protocols coming up, whether from the IAB or not, all the time. I think there are some huge opportunities for agencies who are, of course, under pressure given the erosion of FTE models with AI efficiency. When we look at marketers' challenge in capturing value from AI in advertising, think of the Unilever creator example right now, but others. We have huge array of problems, but they differ fundamentally between how far in the AI journey you already are as a marketer. So for those who are just starting out, service providers like agencies or consultancies can provide things on technical infrastructure. How do I actually increase adoption? How do I scale? The interesting thing is, even when AI engines have been built, the advertising or the media model doesn't go away. If you look in the middle of this chart and look at the operating model, i.e., how do I operate such a system? And how do I implement a media operating model on top of it? These are key questions, which, if you're not just selling media, is a very interesting model to get into. So for market participants, to wrap up, kind of 3 choices in this new world of AI. Landowner, you own the data, you own the models, you own the outputs. A farmer, you just work on a third-party stack, or probably given the EU and the spirit of collaboration that we have, the notion of a landscape architect, building bridges, connecting ecosystems, and forging partnerships. I hope that gave you a kind of a whistle-stop tour on what's going to expect us in 2026, where we shouldn't worry too much about the economy, but how fundamentally marketer preferences and shifts are defining everything downstream. And it's not a technologically determinist view through AI, but it's really about marketer financial motivations. And with that, thank you very much. And back to you, Laura.
Thank you so much, Daniel. There was so much information there. I was in the background making on my own notes about everything as you're doing, as I'm sure many people on the call have been as well. So thank you so much for that. We had a couple of questions that came through. I guess just firstly, just to try and summarize it a bit, because there was a lot of different dynamics that came in there. And you sort of said that there's going to be hopefully this reacceleration in ad spend next year. How optimistic do you really feel about that next year? Like, are you optimistic as we go into 2026 for the industry?
Given the factors discussed, I'm optimistic. It's not going to be this horrible year that we've seen before during times of kind of economic downturn. There are too many macro factors at force that are propping up the ad market.
Good. I think everyone will be happy to hear that. There was a couple of other questions that came through. So this, I think, was more towards the beginning of your presentation. So somebody said, given how corporate profitability seems to drive ad spend, I'm curious if that correlation is more pronounced for B2B versus B2C ad spend. Does any data exist around this distinction?
We haven't looked at the split. So since the US data overall is much more granular than the European data. We haven't looked at the split, but the largest advertisers are, of course, B2C advertisers. And so you'll see a strong element of B2C in the data. Unfortunately, I don't have specific data on B2B. The US might supply it. It's fairly granular. In Europe, as it's all aggregated from national accounts by Eurostat, we are unfortunately losing out a little bit on granularity.
And there's some nice praise for your presentation here, says Daniel. Thank you for your fantastic presentation. That you highlighted that CMOs are talking about AI and creators as the top two topics. Are these intertwined as interests or exclusive? And what do you see the opportunity as being for using AI to generate better and more creative, particularly for small, medium businesses?
Yeah. Well, I think first a word of caution on the corporate earnings calls. It's a fascinating tool, and we're doubling down on it. We're going to provide far more detail on this in the future. But of course, talk isn't action. And there's a lot of posturing on there and trying to convince investors. Right? This, in a sense, is a sense of financial PR as well. So they need to hit those sweet spot topics. And you even have anecdotes of CEOs speaking about their own kind of TikTok exploits, etc. You can see kind of how far this can go. So there's always a gap between the emphasis of terms and where money really goes, right? But it is indicative of trends in the industry, as they can't really renege from those things. So the creator world and the AI world, I think, have been largely treated separately as separate opportunities. The creator world mainly came about through frustration on one-on-one targeting, of trying to build more cultural relevance and go back to this 2012 notion of cultural communities. Every term in this industry has a rebirth at some time, but then suddenly the scale, the platforms, the tools are there to actually make it happen. Now, as you have seen, and I think that your suspicion is right, that these things will increasingly become intertwined because in this financialized world of marketing, everything needs to generate outcomes. So it's questions about which creator do I choose? How do I orchestrate it? How do I measure success? Video analysis on where does an ad work best? I hold up the shampoo bottle, or at the beginning of the video, or some deeper brand integration, all those different things, right? And then, of course, we don't have data on it yet, but it's just a trend for now, the rise of AI influencers, and some are even saying that the rise of AI influencers could even undermine the business of carbon influencers, if you will.
Be interesting to see that. Okay, brilliant. Thank you so much. I'm just checking if there's any more. If we've got time for one final question. Oh, just another thank you for all the interesting stats there, Daniel.
Well,
Okay,
thank you all for joining. Really appreciate your time.
We are very much at time, so that was perfectly timed. Just a very quick note from us to say, if anyone is interested in joining or participating in the work of IAB Europe, do get in touch with us. You can find the details on the screen. And also just to wish everyone a good festive break, and we're very much looking forward to seeing and working with you all in the new year. Have a good rest of your afternoon.
Record.